Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. And we saw some interesting price action, didn't we, in the New York trading session yesterday. And it's really in keeping with what I've been saying all along. This is now a bear market for stocks and any rallies should be sold. The market is only just beginning to understand the ramification of what Fed Chairman Powell has been saying all along, and rates, everyone's getting used to the idea that, oh, they go higher before they pivot. No, they go much higher and then they don't pivot. That scenario is just not priced in at all. Usually when the Fed's had an aggressive hiking cycle, historically, it's 6 to 9 months before any other change. And in this case, it could be 6 to 18 months. If inflation stays above the target range, the Fed will not be cutting rates. So the markets have not at all priced what I'm saying in. They still think that it doesn't matter, it's going higher for longer, but then it's going back down. No, it's not going back down. We could be seeing interest rates on a 10-year movement to the upside, just as we had a 10-year movement overall to the downside. So there could be some rate cuts here and there in 1, 2, or 3 years' time. But overall, the historic thrust of interest rates in the US and around the world is to the upside. That is the game. So people need to adjust to that. This is why equity markets, on any further confirmation of all the things I've been saying for the last year, is having these sharp down moves. Part of the reason is the new information, or they see it as new. It's not new at all. But the other reason is the positioning in the market. Everyone's been told, just keep buying. You know, when you see a lot of commentary in the financial media, it's about, okay, so we think things could be tricky for a while, so we think you buy this. I've been saying all along, play defense, don't buy anything. And it's been by far the most effective strategy. Of course, you can buy short positions. Of course, you can buy commodities or things that will do well when there is an economic crisis, perhaps. Now, I don't think we're going to have a full-blown economic crisis, but we're going to have a continuation of a global economic slowing. China's not going to bounce back as well as everyone had hoped for. It is bouncing back, but not as well as everyone had hoped for. And again, that was my central theme over the last year, that COVID was masking a permanent slowing. While we're in Asia, let's look at Japan today. Bank of Japan meets. The outgoing governor, Governor Kuroda, has probably done a very good job in his tenure there. He is unlikely to want to rock the boat. He's going to want to give a steady ship, if you like, as he passes over to the incoming governor, control over to the incoming governor. Therefore, while many could argue, and I had myself been thinking perhaps the BOJ could do a small nudge, I don't think they will. I think it'll be no change from the Bank of Japan today. That could see a momentary weakening of the yen, though I do think the yen is a strong currency over the foreseeable future, because really when you look around the world and you see a war in Europe, you see the state of the US with interest rates going up and their trade deficit, their fiscal deficit, their debt ceiling woes. I mean, the problems in the United States are extreme. So now we're going to have an incredible tussle over the US budget. Republicans are not at all happy with Biden's proposed budget, so that could be a drawn out process and affair as well. So a lot of uncertainty around the US economy. The only bright spot being a little bit of a movement back into positive for services recently with the ISM there in the US. But remember that services ISM PMI had been in negative territory. So the US economy has had a moment of some hope, but this does not confirm the US economy is going to be stable through the rest of this year. I still see the US economy tipping over through this year. Meanwhile, in Europe, you've got the conflict in Ukraine, which everyone's trying to look past now, but it could escalate. And this is the thing I have been warning people about. It's a tragedy and we don't want it, but it is what it is and it could escalate, and that could again spook markets. Given, as I was just alluding to, positioning around the world had got very long of equities again, and that positioning is finding itself to be a little bit too keen and a little bit misplaced. So as we get more and more information about the Fed continuing to hike interest rates to at least 5.75, probably 6.5, and risk 7.5%, as all of that knowledge starts to become more common in the global economic and financial market community, people are going to be far more circumspect about holding their equity positions. That's why I've been warning it is still a process of playing defense when it comes to equity markets. In terms of Japan and the yen, as I said, I think it will be strengthening and continue to strengthen, but on the day a little bit volatile. The euro has tried very hard to turn into a bull market again, but I think it's looking a little bit tight. So I'd say the US dollar as a whole could be a little bit sideways here, but it may begin to strengthen within the next 24 hours against both the euro and the Australian dollar. We've seen significant weakness in the Australian dollar, which is what I've been saying. I think Australia is in a very difficult position. Should there be any confrontation, military confrontation between the US and China, global investors will exit the Australian equity market and the Australian dollar as quickly as they can. So those two markets become very exposed should any risk of conflict grow further, ratchet any higher, because we know China had very strong words this week towards the US, saying it would not tolerate any more, as it says, crossing of its lines in regard to Taiwan or containment, and it would retaliate in future, that its patience had worn out. So there is that heightened risk now, and the Australian dollar and the Australian equity market are not happy markets in such an eventuality. I don't think those things will happen. I don't think there will be military conflict. I really don't. But if you're a global investor, it's got to weigh on your mind a little bit that perhaps there could be. Thanks very much. All the best. Clifford Bennett, Chief Economist, ACY Securities.